pension credit now that we've hit the close of our second quarter. I'm thrilled to have Lori Peterson and Carrie Heyman here to join in on the conversation. Hi, guys.
Good afternoon.
Before we dive in today, we have some housekeeping we want to cover. We have the ability for live Q&A during our session again today. In order to participate, you must register and log in using the link below me. So if you need to take a second to do that, please do so. The questions do appear for you in the audience to see and like and move up in priority so that we can answer them while we're together. We also have moderators standing by in the chat, ready to engage and interact with you. We have a scroll rolling through today's session of our coming events, so you can register for those on our website, and please do check them out. There's a lot of good content this summer. Also, as you know, for the summer, we're planning to host the live stream, and we have been hosting the live stream every other week so that you can take the time to dive in on these events. Don't worry, though, if we need to come back with the new legislative updates or urgent content, then we'll return to our usual weekly cadence. We also plan on coming back to that in the fall. In addition to the other thing I'd also like to advise you about is in addition to the webinar scrolling below me, please be on the lookout for articles, blogs, and other white papers providing additional guidance. Carrie is a prolific blogger we've seen, and he was just telling me the easiest way to access those is blogs.claconnect.com, and you'll be able to find all 11 of our industry groups blogging away. And as always, call your CLA relationship if you'd like to engage or if you have questions. We want to interact with you. So let's get down to business and start the conversation today with Lori. Lori is a tax principal who focuses on individuals and trusts and has a strong knowledge of these current programs. So Lori, thanks so much for joining us. Before I ask my first question, though, I think it's valuable to talk through this legislative journey that we've experienced in the past year. So I'll provide that background, and then we can dive in deeper as far as how all this impacts us from an estate and gift perspective. But as many people know, on January 14th, we announced the American Rescue Plan. On January 20th, Biden was inaugurated, and on March 11th, he signed the American Rescue Plan into law. On March 30th, they signed the PPP Extension Act of 2021, and on March 31st, announced the American Jobs Plan, and that's the infrastructure plan that we're talking about so much and hearing so much about. On April 7th, Treasury released the Made in America Tax Plan report. On April 9th, the OMB released the outline of the proposed budget. On the 27th, we saw the American Families Plan fact sheet. And on May 28th, we have the administration's revenue proposals, otherwise known as the Green Book that we've been talking a lot about. So a ton has happened in this first 6 months of the year, but we still have a long way to go. And there's a lot of proposals out there as opposed to what's been signed, because honestly, the last thing that we've seen signed into law was on March 30th, which was that PPP Extension Act of 2021. So Lori, I want to bring you into the discussion now that we've just kind of got that list of everything going on, to ask you kind of what are the key gift and estate proposals and items that have been included in all of these plans that are in front of us.
Sure. Thanks, Jen, for having me today. So, in the proposals, and there's, as you said, there's several of them out there. Sort of the really key things from a gift and estate tax standpoint is a really new concept that we haven't had before in the gift and estate tax area, which is this capital gains tax upon a transfer or upon death. So a realization event when there's a gift made during somebody's lifetime or when somebody passes away. There would be we had talked a lot about eliminating a step up in basis, but really what they're saying is you can still have a step up in basis, but you have to pay for it. Today it's free. In the future, you'd have to pay for it. Importantly, there are some exemptions, so not everybody would be subject to it, but it's pretty low. It would be $1 million per individual, so $2 million for a married couple. And again, if you made a gift to an individual during your lifetime, you would realize any appreciation on that asset at the time you make the gift, and it's the donor who would be paying that tax. And likewise, upon somebody's passing, you would pay a capital gains tax on any appreciation in their assets. So it's would encapsulate it would encompass a lot more taxpayers than the current gift and estate tax regime, which currently, for federal purposes, we have an $11,400,000 exclusion before we have to pay any gift or estate tax, over $22 million for a married couple. And one of the really important things that I think hasn't gotten a lot of press is that this isn't a proposed replacement of our current gift and estate tax regime. It's in addition to the current gift and estate tax regime. So you would have this capital gains tax that would be paid on the appreciation. And for taxpayers over that federal exclusion, they would still pay an estate tax. Although the income tax that they paid on the appreciation would be a deduction. So they give you a little bit of benefit there, but still pretty onerous system that we would have if that were to pass. So I think it's really important to take note of that. It greatly obviously impacts gifting, whereas today you could pass a significant amount of wealth and move all that appreciation to the next generation. You couldn't do that under this plan. You'd have to pay tax at that point in time. It certainly limits some of our clever estate planning that we do today using gifts and sales to defective grantor trusts because the sale to the trust would be taxable, even though it's a grantor trust. The gift component would be taxable if you were transferring appreciated assets. And then additionally, there would also be a capital gains tax on trusts every 90 years, essentially. And that 90-year period starts from 1940. So actually the first realization event, if this were to pass for those long-time trusts, would be in 2030. And again, it would be that untaxed appreciation is taxed as if all the assets were sold. And it certainly begs the question, if I have to pay tax on my assets as if they're sold, how do I pay that if I haven't in fact actually sold any assets? Now, from an estate tax standpoint, there is a spread out payment plan built in. What's proposed is a 15-year payment plan to cover that. And then there's some exemptions for small businesses and farms where those actually would not be taxed until either the business or farm is sold or until it ceases to be controlled by the family.
Well, Lori, that's so incredibly helpful, I think, to understand sort of what those realization triggers are and what's been proposed. I mean, to be clear, none of this has been passed, right? To this point, nothing's actually changed
That's
as
correct.
of today, right? So, what is some of the best guidance that you're giving people? I know we talked about this kind of in advance of, understanding all of these realization triggers that are proposed and in place, and could be put in place. Um, what do we do with all of that? And kind of what is your best guidance right now from an estate and gifting perspective with all these unknowns?
Well, I think my first word of advice is don't panic.
Mhm.
Don't do something that you wouldn't otherwise be comfortable doing, because to Jen's point, nothing has passed at this point, and nothing is imminent based on what's going on in Washington. So I think if you're concerned about the amount of additional tax you might have to pay if this were to come to fruition, I think it's important to have a plan in place. I think certainly if you would otherwise be comfortable making a large gift this year, to go ahead and do that if that was part of your plan anyways. I know we've been talking to a lot of clients about potentially making large gifts. We've been worried that the current exclusion of $11+ million was going to be reduced. That seemed like the most likely target. This sort of took us by surprise that we'll just leave the exemption at $11 million because we don't care that much about that. If we put in this realization tax instead, it certainly would generate far more revenue than the current gift and estate tax, which generates a very small amount of revenue. So again, if you were planning on otherwise making a large gift, I don't see any reason not to do that. It's unlikely that any of this would be retroactive. But again, I wouldn't panic, make a large gift to try to avoid something that hasn't yet been passed and may not be passed this year or next year. I think having a plan in place in the event we think it's going to happen is good, to be prepared, but let's not overreact and do something that, after you sign those gifting documents and giving away $11 million, you might really regret.
Yeah, well, and Lori, I think that's so wise. We talk about that too, just in my field in business incentives consulting too, where it's like, let the business decision or let the planning decision be the decision. Don't let the tax consequence or the credit or the incentive tail sort of wag the actual decision dog, right? Like, let's keep everything in line with the way we want to do it. And that's really I love hearing that consistent, wise guidance from you too in this point, because there is so much that goes into it. And obviously, tax and all the consequences and the planning opportunities are, it's imperative that we're aware of them, and that we plan for the various scenarios that could happen. But the last thing we'd want to do is give some guidance, especially now when there are so many unknowns, have it trigger a gifting event or something like that, that ultimately the person, or in some cases the organization, didn't intend or didn't really want to do, because they were just acting out of fear. So I really think that advice and that guidance is spot on and appropriate for everyone to hear, with consistency across the messaging, whether it's on the individual side or the organization side. So I really want to thank you for that. And we're going to talk to Carrie for just a bit now, and then have the three of us come back and unpack a little bit more of this. So thank you so much for kicking us off on the right foot here, Lori. I appreciate it. Um, Now, Carrie, I think um, what we should best do, welcome back to the live stream, because it's only been a month since, or it's been a month since we last saw you. So what I'd like to do is just continue some of that discussion on a deeper level about, really what some businesses can be doing from a tax planning perspective. So for those of you in the audience, Kerry leads our real estate industry group, and he's been a thought leader in this space, whether it's in his blog or just in his client interaction. So Kerry, welcome back.
Thank you. Thank you so much, Jen, for having me. What really helped cushion the blow for me on everything that Lori covered was her stuffed animals behind her. I don't have any
Yes.
stuffed animals behind me, so I'll be a little more pessimistic. Um,
You'll,
Lori really said it perfectly, and Jen, you reiterated it just now. Staying flexible with all of this out there, right? Nothing has been passed yet. We thought infrastructure was a bipartisan thing that both parties could get behind, and that would pass pretty quickly. I mean, I hit too many potholes on my way to work. Sewer pipes are breaking, all this kind of stuff. Infrastructure, high-speed internet. Infrastructure makes sense, but we are now, I don't know, 6, 8 weeks past the announcement of that proposal, and we are nowhere. We thought a week and a half ago we had a bipartisan agreement in principle. The White House spearheaded that, found people on both sides of the aisle. A lot of centrist Congress people focusing on that proposal, and then all of a sudden they get a mic in their face and everything goes to hell. So the infrastructure plan has to kind of get through before we can even focus on the American Families Plan, which is where a lot of that estate and gift tax and that appreciation or taxing appreciation kind of comes into play. So we have a long way to go. So it is important to keep tuning into the live streams, keep checking CLAconnect.com for more content. We're evaluating all of, everything that's going on in DC. And let's be honest, there's a lot of
Yes.
Thank you, everybody. We had just a few technical glitches there, but I'm happy to say that we're back. I'd like to, Carrie, come back to you just to clarify and close out sort of that part of that conversation that we were having, which was, you know, we keep saying stay flexible in your tax planning, and we know that there's a lot of frustration around hearing that guidance now, whether it's from your professional services advisor, from financial perspective, or an assurance, tax perspective from your attorney. Everybody's saying the same thing, and so I think, to your point, you were really saying, like, well, there's a reason for that, right? Like, the infrastructure plan that we thought was going to come through faster, it's still on hold. So then as they navigate through that to get us to American families and to a point where they can hammer that out, there's going to be some budget reconciliations that might make tax planning at the end of the year quite a blitz, right? And so that's why we keep saying that let's be flexible there. Does that fairly restate or recap some of your
that
comments there?
that recaps it very well. Are we sure we want to come back to me, because DC may have shut it down our live stream for my comments though?
They could have,
Yeah,
but
that
you
was
know
my
what?
fault. That was my fault.
Yeah, I don't think George Orwell really is right in that. I think we can keep moving there, but one thing we can do, Carrie, is, and one thing that is actionable that's
the replacement property within the 180 days, with the last possible day you can do it being December 31st, 2021, that you wouldn't qualify for a gain deferral under the Section 1031 exchange rules. So right now we're sitting on July 8th, 2021. We have less than 180 days, and depending on where you're looking to buy a replacement property, like for example, I sit in Los Angeles, California. It's really hard to find a good replacement property at appropriate cap rates. So oftentimes you start at home, you look around where you want to buy, then you go out of state. We're expecting to see a lot more 1031 exchanges through the rest of the year. We're also seeing an uptick in interest in Delaware statutory trusts and opportunity zones. Just note, not all states conform to the opportunity zone rules, but those are two other ways to defer gains for, as long as you're going to hold the asset for.
Carrie, I think that's super helpful to understand, and I appreciate, and I'm sure a lot of people do, that as part of their tax planning strategies, there are some things that they can actually execute on right now, because I know a lot of, whether it's an organization or an individual, they feel part of that feeling of fear or being trapped is like, gosh, I don't know what to do. And this is something that's relevant that can be done right now, right? So thank you for, I think, giving that guidance and sharing an action item that makes a lot of sense for a lot of people, regardless of what occurs. So I appreciate that. One of the other things I wanted to ask Lori, and bring you kind of back into the mix here, and Carrie actually brought it up when we were talking before the session of, what about any of these proposals sunsetting, and what would that, what does that look like, and kind of what are those dates? And I know you mentioned some of that, but could you talk about that and the impact that would have?
Yeah, of course. So the current proposals regarding the realization triggers via gift or at death, or after 90 years of assets being in a trust, they don't appear to have any sunset provisions drafted into the proposals. So this looks to be permanent legislation is what they're looking for, but as we know, no tax legislation is truly permanent, but there isn't a sunset like there is in the current gift and estate tax world. As I'm sure many of you know, the 11 million exclusion that we currently have is scheduled to sunset at the end of 2025. That was part of the 2018 Tax Act when we had a lot of tax cuts. We also had some unintended tax increases, perhaps based on the loss of some deductions. But many of those provisions were scheduled to sunset at the end of 2025, and the doubling of the estate tax exclusion was one of them. So barring any change to, again, the exclusion, which it doesn't look like right now they're going after, come January 1st, 2026, it essentially gets cut in half. But again, these realization proposals don't appear to have a sunset included.
That's really interesting too, to understand. I mean, as things move forward, that is going to have a part to play in this tax planning that we do. The other thing too, I think that's going to come into it, and Carrie, you brought this up as well, is the valuation, right? Like that's going to be such a huge piece of this. And I was wondering if you could speak more to that as well, and then maybe we can roll it into some questions. I know, and I might actually take some time and have you repeat some of your key pieces on the 1031, just because we did have a few technical glitches there. But first, could you maybe address some of the importance of having solid valuation going on through all of this?
Yeah, my pleasure, Jen. There's going to be such an administrative burden placed on taxpayers to have an appraisal done on properties if you need to value them at the end of the year. From a stocks bonds perspective, we get that information through a 1099. If you're buying a property, selling a property, getting new debt on a property, you're getting an appraisal. The bank's doing an appraisal, you're doing an appraisal. So those values are there, and it's the market value, right? It's a bigger issue if you've held an asset for 20, 30 years and you haven't had one of those situations. So now we're putting the administrative burden on the taxpayer to get appraisals to report an increase in value, likely an appreciation in the value of the underlying asset on their return. So I would be really happy if I was in the appraisal world, which maybe that's soon to come from CLA. That's a little
it's a little tease, right?
A little
tease, but something that's important, right? And you explained very well the reason behind it.
We are just so far removed from former President Trump's pledge for a postcard. I mean, my clients always ask me, when's the postcard coming? And then you read these proposals, and this cannot be the furthest thing from the postcard. So I would love to say that professional services firms, CPAs, attorneys are behind all these proposals. We're not. We will likely be the main benefactors of these proposals. But this is something that is just going to place a huge administrative burden on both of our fields and onto taxpayers. Luckily, the appraisals would be fully deductible. So if there's a shining light in any of that, they would get the deduction for that.
You know, I always count on you for the silver lining, my friend. So thank you for sharing that. Now, we do have a bunch of questions coming in from our audience, and I really want to engage and interact with them. Again, we did have just a quick technical glitch. So, Carrie, the first question is really, do you mind just repeating a handful of the highlights from 1031 exchanges,
Sure.
just
So
what it is and why
just
it's
a quick
important?
recap: 1031 exchange. You sell. You're looking to defer the gain on the sale of the property. You got to do you got to purchase replacement property within 180 days. You have a 45-day identification period. There's certain tests that you can look into. There's a bunch of them available of how many replacement properties you can identify. Long story short, for under the American Families Plan proposal, the gain eligible to be deferred would be limited to $500,000 for individual taxpayers, $1 million for married filing jointly taxpayers. And what we're reading is the 1031 exchange would need to be completed. Again, this is assuming that the American Families Plan or some component of this gets passed, that you would have to complete the 1031 exchange by December 31st, 2021 to be eligible for 100% deferral of that gain. So effectively, if you're in the middle of a 1031 exchange and you're not done by the end of the year, it's possible that you're going to be subject to whatever comes from this American Families Plan.
Thanks so much. I think that's super helpful. So the next couple of questions that are coming in, and probably the top question, Lori, that's coming in from our audience, I'm just going to read it. It's, would a charitable gift of appreciated securities to a private foundation trigger the capital gains tax?
So thankfully, there's some exceptions to the realization event for gifts, and specifically those would be gifts to charitable organizations. They haven't carved out an exception for private foundations, so it would appear that you would not have to realize the gain if you transfer those to your private foundation. Certainly not if you transfer them to a public charity. Again, usually try to provide benefit, right, for making gifts to charities. So those would still be excluded from this realization tax. Also excluded would be transfers between spouses. You could still continue to move assets between spouses without having a realization event. It's basically any other gift or upon your passing, there would be that realization event, but charities are accepted.
Excellent, excellent. I think that really helps unpack or at least answer that top question. The follow-up was, from someone who wants to leave the bulk of their assets in cash to their foundation, and how will those changes affect that person who seems to have art collections and some other tangible assets?
Yeah. So really, if your intent is to leave the bulk of your estate to charity, again, you should be saved from these realization taxes, the capital gains tax at death, because there should be, again, an exclusion for anything going to charity, much like there is under the current gift and estate tax regime. If you leave your estate to charity, you get a full, offsetting charitable deduction for whatever passes to charity. The capital gains realization should be the same, where you wouldn't have to realize the gain on those assets passing to charity. And again, probably makes charitable giving of appreciated assets even more valuable. I mean, even today, we talk to clients about making those gifts of appreciated securities rather than making them in cash, just to save the recognition of that gain. Again, if we have this realization tax, it will be really important to think about strategically, what assets do we give to charities and what do we leave for our other heirs.
Excellent. Thank you for that. I've got one more on this with the capital gains. And the question is, when we sold property, we had a gain of $100,000 and bought bought again in less than 2 years. So do they have to, I guess, Carrie, this one would be for you. So if you sold it, had a gain of 100,000, then rolled it into a new property within a 2-year window, do they have to pay tax for the capital gains on that property?
Yeah, yes, they would. I don't know if it would all be capital gains rates or some of it would be ordinary, depending on if you have recapture or not. Don't mean to get too into the weeds on that. But the 1031 exchange rules are very specific. In the current form, you have 180 days, the 45-day requirement. It sounds like in this case, and maybe I'm not reading or understanding it completely, but it sounds like you would have had to pay tax on the gain on the disposition of that property.
Excellent.
Unless
Excellent.
unless we're talking primary residence, where that's a whole different rule that wouldn't qualify here. That's the 2 out of 5 year rule, and
Okay. So the the short answer to that is contact us for
just
more
call us.
information.
Exactly.
Yeah. Set up a consultation with your advisor. Now I will take this last question. I'm just going to ask it of myself and respond quickly to it. That was an employee retention credit question. Like I said, that is a sleeping dog a little bit for this session, but definitely one that's pretty active. And the question is there any guidance yet on the employee retention credit for third and fourth quarters of 2021? Um, we don't have any new notices beyond what the two notices that were issued, in I guess March and April of this year on that. So we've got some expanded definitions under the American Rescue Plan of a qualified small startup business, and I think they call it just a severely distressed business. So the qualified startup business would be able to take advantage of that credit if they started after February 15th of 2020 and had less than $1 million in revenue. They will be able, just by virtue of those two facts, be able to qualify for up to $50,000 in credit in Q3 and Q4. And then the severely distressed business is one that even if they're over 500 full-time employees in 2019, if they have a 90% decline in gross receipts compared to any quarter in 2019, they'd be able to take the credit on all of the wages. So I think that's all we know at this point as far as what's different in Q3 and Q4, but we're anxiously awaiting any guidance that the IRS has to give us. So with that, I think that closes us out from a timing perspective. Lori, Carey, thank you so much for joining us with this incredible guidance on everything that's going on legislatively. I know people are hungry for not only information and just movement and progress, but some action items that they can get their arms around. And I think you provided that to the best of your abilities or anybody's ability at this point. So thank you so much for your time today. Thank you to those of you in the audience for your great questions and engagement, and to our moderators in the chat for keeping things moving along. We look forward to seeing you in 2 weeks. And until then, please stay safe and healthy. Thanks so much for joining us today.